We're going to start off, as he said, talking about spring-loaded compensation and some other issues. And I'm going to start you right off with a polling question. So as Rick mentioned, especially if you want CPE, make sure you answer the polling question. So what are spring-loaded options? Are they options that bounce around between different holders? Are they options that are loaded with tax issues and are only issued during springtime? Are they options that are issued just prior to a positive news release, or you have no idea? I think I made this pretty easy, just trying to make sure everybody's paying attention. So go ahead and make your selection. As you all probably guessed, answer C. And they're not just options. It can be any kind of spring-loaded award. And those are awards, it's any kind of compensation where the company grants options or an equity award right before market moving information, like better than expected earnings or a big important transaction, or for all you biotech companies out there, it might be FDA approval or some kind of milestone in your research. So the options, of course, then have the potential to soar once that news is made public, which then provides immediate profits to the executives. Now, on the next slide, I've got a real life example of this for you. Back in summer of 2020, Eastman Kodak stock surged to its highest level in 6 years when it announced that it was going to get a very large loan from a government entity to help fund some making drugs against protection against coronavirus. The day before they made the announcement, they handed out a bunch of options to their executives. Some of those options vested the day they were granted. So they were already vested. And then the next day they make this big announcement. And of course, the stock soared to its highest level in 6 years. Specifically, the executive chairman stood to gain more than $95 million from that increase if he had exercised at the then current prices, which he didn't. So the company wasn't charged with any securities violations because technically this is not illegal, but investors have long considered it to be misleading or manipulative. And the SEC monitors it for potential securities violations. But in practicality, companies have been using this practice for years as a way to quickly compensate their executives. So now the SEC is focusing more on it. Specifically, the SEC chairman, Gary Gensler, said it's important that companies' accounting and disclosures reflect the economics and terms of these compensation arrangements. So in November of 2021, just a couple months ago, the SEC issued some new guidance on how companies should recognize and disclose the costs issued with these awards. They advised companies to fully consider the impact that this significant non-public news could have on the value of the spring-loaded compensation. So what are the specifics of this guidance? What does the SEC want you to do? They want you to consider whether it's appropriate to adjust either your current share price or your expected volatility when you're coming up with your compensation amount. So, historically, we plug in, we're plugging into our Black-Scholes model the current share price, we calculate the historical volatility and the other inputs, and it gives us the price, and that's what we record. Well, the SEC says, maybe not so fast. Maybe evaluate those inputs a little more, and maybe you need to make some adjustments. So, of course, that's going to require some significant judgment. And the SEC says, at a minimum, even if you're not going to change your accounting, at a minimum, the SEC expects that you would disclose how you determined that current share price, when an adjustment is required, and any significant assumptions that were used to calculate that adjustment. So now the SEC is saying, look at your accounting, adjust your disclosures, and then, of course, the last piece of that is going to be remember you need to adjust your internal control over financial reporting policies and procedures as well, both for the accounting and also for the disclosures once you determine what those policies are in regards to these adjustments. So that is the update on spring-loaded compensation. I also wanted to just touch quickly on a couple of other topics from the conference. Revenue recognition and segment reporting. The Office of the Chief Accountant was saying that they noted some recurring themes in accounting consultations, specifically on revenue recognition and identification of performance obligations. They noted that there have been a lot of consultations on whether a performance obligation is distinct or not. And remember that in order to qualify as distinct, it has to not only be capable of being distinct, but it has to be distinct within the context of that contract. So they've had some consultations around that, some around principal and agent analyses. And then when it comes to identification of the customer and consideration of payable to the customer, they've noticed some consultations that it's been difficult to identify those last two items when there's more than one party getting incentives in an arrangement. It's just been difficult to identify. So they have had a lot of consultations around that. And then a takeaway on segment reporting. They noticed there's been some consultations on some segment reporting. You don't want to think it's a check the box, one and done and move on. That's a continual process. Everyone knows that you're supposed to look at the chief operating decision makers' responsibilities and processes when you determine if what your segments are. Well, the chief operating decision makers' processes could change over time. What they're looking at could change, especially as your business changes. So just remember, as the role of that person changes, so should your evaluation of segment reporting. So that is all I have for today. I'm going to hand it over to Pat to talk about the SEC views on materiality. Thanks, everybody.